Let me ask you a question. Do you want to learn how to invest like the pros and take your stock trading game to the next level? Warren Buffett, possibly the most successful and respected investor today, has been quoted saying that The Intelligent Investor is by far the best book on investing ever written. In his preface to the 4th edition of the book, Buffett tells the reader that successful investing does not require a stratospheric IQ, psychic powers, or insider information. Instead, successful investing requires 2 things. First, a sound intellectual framework for making decisions, which the intelligent investor provides. Second, you must have the discipline to keep your emotions from corroding your ability to make wise decisions, and this requires self-control and self-awareness. Now, while neither I nor Benjamin Graham can help you with your self-control, the intelligent investor clearly and precisely outlines the sound intellectual framework you need to make solid investment decisions. So, do you want to make more money investing? If you do, stay tuned. Don't move, because we are about to discuss 3 key lessons from The Intelligent Investor by Benjamin Graham. Let's get right into it. Lesson 1. Decide what kind of investor you're going to be. Graham breaks intelligent investors into 2 groups: defensive investors and enterprising investors. The defensive investor is discussed in chapters 4, 5, and 14 of the book, while the enterprising investor is discussed in chapters 6, 7, and 15. Now, let's start by talking about the defensive investor. The defensive investor is a passive investor. The goal of a defensive investor is to earn an average return. The defensive investor creates a portfolio that runs on autopilot and requires minimal effort and time. This investor selects a balance for his or her portfolio, say 50-50, with half of the portfolio invested in stocks and the other half of the portfolio invested in bonds or cash. As the market fluctuates over time, the defensive investor will periodically engage in portfolio rebalancing to keep the money value of the portfolio at the desired 50% stocks, 50% bonds ratio. Graham outlines a set of 7 rules or criteria for stock selection that the defensive investor should follow. First is adequate size. Defensive investors should only invest in large companies, those with at least $2 billion in total market value. Second is strong financial condition. The company's current assets should be at least twice its current liabilities, because with this cushion of working capital, the company should be able to survive hard financial times. Third is earnings stability. This means that the company's common stock should have positive earnings in each of the past 10 years. Fourth is dividend record. Defensive investors should look for companies that have paid a dividend for at least 20 years in a row. Fifth is earnings growth. A defensive investor should only invest in companies with 33% cumulative growth over a decade. This is a pretty low hurdle. It's a little less than a 3% average annual increase. Quick note. The commentary on Chapter 14 points out that a cumulative growth of at least 50%, or a 4% average annual rise, narrows your choices of companies significantly, and a cumulative growth of 100%, or 7% annual growth, narrows your choices even further. Now, let's move on to the 6th criterion: moderate price to earnings ratio. The defensive investor should limit himself or herself to stocks with a current price that is less than 15 times average earnings over the past 3 years. The 7th and final criterion for the defensive investor is this: moderate price to book ratio. The ratio of price to assets, or price to book value ratio, should be no more than 1.5. Now, let's talk about the enterprising investor. The enterprising investor is an active investor. Unlike the defensive investor, the enterprising investor's goal is to achieve above average or even extraordinary returns. Thus, rather than maintaining a balance of assets like the defensive investor, the enterprising investor continually researches the market and stock prices and actively manages a dynamic portfolio of stocks, bonds, and/or mutual funds to achieve maximum results. Graham provides a list of 5 rules or criteria for stock selection for the enterprising investor. The first criterion is financial condition. The enterprising investor should select companies with current assets of at least 1.5 times current liabilities. Second, earnings stability. Select companies with no deficit in the last 5 years. Or, put another way, the company should have positive earnings for the past 5 years. Third is dividend record. The company should pay some current dividend. The fourth criterion is earnings growth. Select companies with current earnings that are greater than the company's earnings sometime in the past. How far you look back is up to you, but you might compare the company's current earnings to its earnings 10, 15, or 20 years ago. The key is to invest in companies that are making more money than they used to make. The fifth and final criterion is this: price. The stock price should be less than 120% of the company's net tangible assets. Now, as an investor, you might note that the above investing rules for the enterprising investor are much less extreme and much less strict than those outlined for the defensive investor. Let's quickly summarize the differences between the enterprising investor and the defensive investor. The main difference between the enterprising investor and defensive investor is that the enterprising investor dedicates lots of time and effort to the science of investing. The defensive investor, on the other hand, puts his or her portfolio on autopilot. The enterprising investor constantly researches the market and invests at the most opportune times. The defensive investor pays into his or her portfolio consistently, which is called cost averaging. Finally, the enterprising investor trades regularly, while the defensive investor rebalances his or her portfolio once or twice per year. So, this begs the question: what kind of investor do you want to be? Let's move on to Lesson 2. Learn how to do business with Mr. Market. In Chapter 8, Graham gives us a brilliant metaphor for understanding irrational market swings, and this metaphor is what he calls Mr. Market. Mr. Market is ruled by his emotions and is easily swayed by the crowd. In exuberant times when everyone is irrationally driving the price of a stock to the moon, Mr. Market will pay you a price far above the fundamental value of the business. In downtimes, when financial conditions deteriorate, Mr. Market becomes very pessimistic and fearful, and he will sell a stock to you at a price far below the fundamental value of the business. Depending on how wildly Mr. Market swings, the difference between the price of a stock and its objective value can be quite extreme. So, let's talk about the 3 rules for doing business with Mr. Market. First, we have to learn to observe Mr. Market closely, to recognize his mood swings, and to profit from those mood swings. When Mr. Market is in despair, stocks are underpriced, and that's when you want to buy. Don't sell to Mr. Market when he's depressed. He won't pay you anything for your stocks. On the other hand, when Mr. Market is exuberant, that's when stocks are overpriced, and that's when you want to sell to Mr. Market. When he's enthusiastic, don't buy anything from him because he'll charge you more than you should pay, which means your investment will have little or no margin of safety. We'll discuss margin of safety more in Lesson 3. Second rule: we have to learn to be strong and not let Mr. Market influence us. Stick to your principles. Don't follow Mr. Market when he gets crazy. Finally, don't feel guilty when you make a huge profit on Mr. Market's emotional mood swings. He set the price and you remain disciplined. Staying objective in an emotional market is no easy task, and you deserve every penny you earn for staying strong and sticking to your investing principles. This brings us to the final lesson. Lesson 3. Practice margin of safety. This is the most important lesson from The Intelligent Investor. Graham said that the margin of safety is the central concept of investment. The margin of safety is your built-in safety buffer for each individual investment you make. In its simplest form, you practice margin of safety when you purchase a stock at a price lower than the valuation. Thus, coming up with an accurate valuation is paramount to putting the margin of safety into practice. Buffett has explained margin of safety like this. He says that whenever we construct a bridge, the bridge should be strong enough to bear the load of a 30-ton truck, even though we know that most trucks riding across the bridge would only weigh in at around 10 tons. The more weight the bridge can bear, the less risky it is for vehicles that cross it. In the same way, the higher the margin of safety, the less your risk for that particular investment. Let's put this on a chart. This line represents the fundamental or intrinsic value of the stock. Anything here is greed. In other words, Mr. Market is exuberant and it's a bad time to buy. Anything over here is fear. Mr. Market is freaked out and it's a good time to buy. If you buy a stock below the intrinsic value line, you're practicing margin of safety. A deep swing below the intrinsic value line, like right over here, well, this is the best time to buy a stock because this gives you the highest possible margin of safety. Anything up here, where the stock crosses the intrinsic value line to the upside, well, that's your time to sell. Of course, selling way up here at the tippy top is best, but it's not easy to do unless you have a crystal ball that works. Now, let's quickly talk about diversification. Diversification is a close companion of the margin of safety. It is the same idea as margin of safety, but diversification is applied to your portfolio as a whole, whereas margin of safety is practiced in each individual purchase. Diversification and margin of safety work together to make sure you don't get cleaned out by a stock market downturn. These principles keep you at the table when others are out of chips. Thank you so much for watching this summary of The Intelligent Investor.